Hi, Bruce Miller here. It's August 24th, 2015. And what a way to start the day. We came in this morning and turned on the computers and found out that the Dow was down over 1,000 points to begin. Now it recovered a little bit, but it still finished down quite a bit, and it's been very much in a pattern over the last couple of weeks. So I thought now would be a good time to have a discussion of what to do and what not to do when you see the market not behaving exactly the way you'd like it to. This is not even compared to some of the things we've seen in the past as far as a market correction goes, but it is technically a correction. The Dow was down from a high of 18,300 down to 15,800, 2,500 point drop in a very short period of time, mostly in August. So it's not been a very pretty month, but it's important to know that these kind of things do happen. They've happened in the past, they'll happen in the future. I wish we could predict them, what causes them. We don't know. We try to filter as much information as we can, but bottom line is always it's some kind of a black swan event that nobody could anticipate. For instance, this time, a couple of weeks ago, China devalued the yuan, their currency. And that sent ripples throughout most currency markets because there's a thought that if a currency war occurs, it could be bad for global growth. Hence, global growth has become the theme, and people are looking at it with not too favorable of an impression right now, particularly in China. Well, why China? Well, China's GDP recently was reduced from 7% down to 6.5%, which would be wonderful for a developed country like the US, or certainly the Eurozone would welcome something like that. But not so for China. You see, they need about an 8% GDP just to keep control of that massive population that they have. And there's thought that there's many underlying frailties within the system that we think are probably we don't hear too much about because they're protected by a communist government that is not a fully capitalized economy. So most recently, after the devaluation, the Shanghai market, which was up a whopping amount, 160 some percent, started to fall, and it started to fall further, and it kept falling and falling, and now it's down about 60% from its high, and that's causing tremendous problems within China for all the folks that are losing tons of money, forgetting the fact that they earned it in the past. Trust me, when you've earned it, you take possession. When you lose it, it hurts a lot more. At any rate, the other thing that we're looking at on the horizon is the September rate cut, or supposed rate cut that the Federal Reserve has programmed in and has us waiting for. There's a couple of things on the rate cut that I'd like to talk about. First of all, with all the things that have gone on in the past month, I don't think we're going to see a September rate cut. I think it'll be pushed to December or maybe even into 2016. Now, I'm not saying that that rate cut would be the worst thing for us because it might surprise you. What I anticipate is that when a rate cut does happen, it's going to be small, a lot smaller than people think, and all of a sudden we'll start to realize again that we can have a vibrant economy in a moderate interest rate environment. And I think after all is said and done, you'll get a positive rally because of that, and how the economy will react in a positive way to the fact that the Federal Reserve feels so strongly about it. And there are a lot of good things that are going on in the economy right now. My gosh, oil today, under $40 a barrel. That means you're likely to see $2 per gallon of gasoline in the next few months. It's probably going to happen in most states. Additionally, besides the dollar, there's other good things that are happening. Construction is on a tear. Have you tried to buy a house recently? It's just like old times, at least in Portland. People are getting 5 or 6 bids when they put their house on the market, just like in the good old times. Now that might mean a bubble is happening again in real estate, but let's set that aside for now. What it really means is that construction is picking up, more multi-income housing units are being built, and more homes are being built, and builder confidence is near an all-time high. So you see a lot of really good things happening. Does that mean that this correction is going to stop? turn around and go up? Well, we don't know. But the only thing that I can tell you is that this is not the first correction, or let's not call it a crash because it's far from that we have experienced over the last few years. And I want to tell you some of the things we've learned from it. 1987, when the market was down a massive amount, 22% in one day. Well, you don't realize that after that day, the market was up about 7% the next day, and it went on and upward from there, and those that stuck with the market at that point made a lot of money. Next case, Y2K, 2000, period 2000 to 2002, when all the technology companies had already pumped out all the technology they were going to pump out, and people just weren't buying anything anymore because they were so pumped up about Y2K. Well, the market fell about 40 or 50% during that 2-year period, and it was an awful time. But who got hurt? The ones that left the market early and never got back in. Well, let's fast forward to 2008. In 2008, I'm sure many of you recall it, it was that terrible time when the market dropped by the most amount of any time in history. If you recall, the global markets for that year were down about 47%, and the U.S. market, the S&P 500, was down 37% in and of itself. It was a terrible time. But who got hurt the most? It were the ones that got out at the bottom and watched that same market rise by 300% over the next 7 years. So this is what we can learn from these events that occurred in the past and that surely will occur in the future. The ones that get hurt are the ones that stray from the goals that they've set, from the risk tolerance that they have. And so now is not a time to look at the market as much as a time to look at your financial plan and see if it still fits what you talked about when you first came in to see your investment advisor or your financial planner. Because you see, what I saw in 2008, people got hurt. But here's what people did. They came in, they sat down, they revised their goals, they revised their financial plan, and they smoothly went forward until they, if the time came, they went on to successful retirement, and many of them are near that point again. The fact is that they stuck to their plan, they stuck to their strategy, and they didn't sell into a panic, which is one thing I want you to know that we will not do. We've set goals, we've set risk tolerances for our clients. We're in a very comfortable mix right now. We have about 55% of our assets in the market, and the rest, another part of investment vehicles that are correlated to the market. And it's somewhere that we feel comfortable with. Does that mean you're not going to lose money in a correction? No, it's not. We wish we could make the right decision in every case, but sometimes you just don't get it right. Sometimes you don't see all the things that need to be seen out there. But the point is you keep trying. And you don't go in with a knee-jerk reaction and go in and push the panic button and sell things at what well likely might be their lows for the next few years. So please, if you're nervous about it, give us a call. We can answer your questions. There's a lot of good things happening. We just don't want to see you get so nervous about the market that you do something that many people do, and that's make the wrong decision. Sell at the wrong time. Buy at the wrong time. So we'll continue to evaluate your investments. We'll probably start to allocate some of the cash that we've been building over the last few months. But in general, as far as the economy goes, I can't tell you what the market's going to do. But the economy looks as strong, as vibrant as it has looked in years. And so in that regard, we're very optimistic. And I hope you'll continue to stay optimistic and give us a call. Come and see us.